There's the futures this morning, not too bad, about 127 points now on the Dow. Let's talk markets with Monica DiCenso, head of the Global Investment Opportunities Group at JPM Private Bank. I don't know, Monica, you're just really not that excited about this market, are you?
It's hard to be very enthusiastic given some of the headline risk and volatility.
You've been risk on for 2 years. You've done well.
Yeah.
There's some headwinds. They're apparent to everyone. That could be good, though.
I think it could be very good. Many of my clients still have too much cash. So for those people, this is great. But there are also people who probably have a little too much risk on. They owned a lot of tech. They did really well. They own a lot of private equity. There haven't been exits. They need to think about rebalancing and just making sure your portfolio is ready for a different volatility environment.
Right. So don't stay at the party too long, but don't.
I learned that lesson in college.
Like call the Uber, but yeah, right. But you don't leave yet.
No, you never want to completely, obviously, sell down and de-risk your entire portfolio. If you did that during COVID, for example, you saw how quickly things can turn around. But that doesn't mean you shouldn't have some portfolio protection on. Many clients I work with still don't own enough fixed income because for so long it didn't make sense. Even though we're worried about inflation, fixed income still makes sense in a portfolio now. Rates are higher.
You think the odds are better than 50% that in the next 6 months we get a 10% pullback?
Oh, I think so. And by the way, I'd be okay with that because I think that would be healthy. What you need to see is a rotation and people start to reposition portfolios, again, out of these 1 or 2 areas that did really well and start looking at other parts of the market. And you're seeing that. That's why the equal-weighted S&P has been outperforming.
So range-bound, but positive.
Yeah.
We're just under 6. You're looking for 6,400 at single digits.
That's our base case for year end. That assumes you're like low double-digit earnings growth, but multiple contractions.
Okay, so I'm uncomfortable. I don't have any tech, but let's say I did have some tech. I'm uncomfortable. So what? So half go where? What do I do?
So I'd want to look at it in the context of your portfolio. And the answer may be sell none, but if you have a lot of cash, do you buy some fixed income and bonds to balance that? Do you think about adding portfolio protection? Do you look at uncorrelated assets, infrastructure, real assets, gold? You know, that's what we just want to make sure people have that balance. People probably got a little too overweight growth in their portfolios the last few years because, again, it was the right trade.
Would you like the Fed to cut a couple of times this year? And would it mean you'd have to give up some economic growth? You'd have to acknowledge the economy is slowing to get the cuts?
Yeah, I mean, that's still our expectation is for 2. I think the risk clearly feels like less than that, and that's what the market is. I think that's what the market's starting to prepare for. That you could see. I mean, the tariff question is a big one, right? If you worry about inflation, then that's the other side.
Are you worried about inflation, or are you worried about the consumer in a possible labor market weakening or slowdown?
The big question for me is labor. As long as people have jobs, they're okay. If that changes, then that changes our outlook. But on the inflation side, again, I think about where do people have risk in portfolios? Where do my clients have risk? And many haven't necessarily positioned for a world where perhaps the tail event is that you have inflation and rates moving higher again. And so that's what we're trying to prepare people for, whether it's trying to manage their floating rate exposure or, again, looking at assets that would perform well in an inflationary environment.
So during the Biden years, the market did pretty well with what was perceived to be a very high regulatory environment. Yeah. If you dismantle that regulatory environment, but at 22 times earnings, I mean, will it be a positive?
I think it's a positive for some sectors. I mean, you think about where we've been waiting to see more M&A, so healthcare. Actually, we've been waiting to see M&A in general. So that's, by the way, good.
And it didn't happen. Andrew pointed that out yesterday.
Didn't happen. Good for certain sectors. Still hasn't really picked up, but the pipeline's really strong. So I think companies are ready if the environment gets a little bit more forgiving.
No exits, you said, for private equity?
Haven't seen many exits. But by the way, if that changes, that's a reason we like financials. It's good for banks who obviously participate in the M&A cycle. And it would be good for private equity. It's why we've seen a lot of people look at secondaries on the private equity side. People need liquidity. There haven't been exits. And so if you can offer someone liquidity, you can get things at a discount. And that's a great trade.
Interest rates are not prohibitively high for M&A. I just don't see what. So you think it's in the works?
Well, it is in the works from every investment.
What do people tell you, Tarkin? They're all your friends, aren't they?
They say in the works.
Yeah.
They do. Selling or buying, both, because there has to be both sides.
Not like a spigot where you turn it on. And
look, the flip side is think about what Steve Cohen's saying.
Yeah.
Go straight to Steve Cohen. Do you think Steve Cohen's one of the smartest investors in America?
Others have echoed similar thing supposedly too.
Right? He's in a very negative camp.
Griffin, yeah.
He thinks the market's moved, and now we're going to be in some kind of rut for some period of time between tariffs, between taxes, between investment, between Doge even. I mean, he's got on a temporary basis. Maybe he's got a longer term view that it could work out on the other side. I don't know, but I'm saying right now he doesn't.
Do you agree with that, Monica?
I do, because if you're running a company, how do you plan when you don't have visibility? And that makes it really hard. Again, I don't think we're not calling for 10, 20% drawdown by year end, but for the next few months, it makes the market feels opaque, and that's challenging.